This video covers the basics of capital budgeting in Chapter 12. I'm going to provide a short overview of some of the important terms, and then we'll go right into the Excel-based calculations. The Excel template is provided in Blackboard, so feel free to work along. Capital budgeting is a subset of budgeting. So we think about capital budgeting as being associated with long-term or capital investments. So these are investments in factories, machinery, more long-term assets. So a capital investment is a project that involves a large expenditure of funds and is expected to benefit future periods over a number of years. And the capital budget becomes part of the overall budget. So a couple important terms. The first is the weighted average cost of capital. So we've been using this idea of a discount factor in some of our previous present value calculations. And weighted average cost of capital is a really good estimate of what a discount factor should be for a large business. And you think of that as it's kind of exactly what it says. What is the cost of the capital of the business? And if we weighted average each of the different forms of capital, we'll get a weighted average cost of capital. And worry not, we will do some examples of that. And so the discount rate is, of course, that generic term that refers to the rate used in capital budgeting for converting future cash flows to a present value basis. And weighted average cost of capital, as I just mentioned, is a great estimate of the discount rate. So if you prefer time value of money tables, which I do not, you can find them in Appendix C at the end of Chapter 12. But I'm going to show you these examples in Excel because the tables are a bit of a throwback to a time when Excel and the basic financial calculator couldn't do these things for you. But in any decent business person probably should not be referring to time value of money tables at some point in their career. So no better time than the present, but they are there if you need them. So when it comes to capital budgeting, there's really three segments of the budget you need to consider. So the first is what's going to happen at the beginning of the project. So what is the investment outlay that includes installation costs? Are there any working capital commitments that are going to need to be made as a function of this new project? And what are the cash flows associated with investment tax credits? Now, the investment tax credit in the U.S. is largely gone, but it does exist in some foreign jurisdictions, and a handful of states provide an investment tax credit. So project operation is the next set of estimates you need to think about. So this is, okay, now I've placed the investment into service. And so what is it doing for me? So what is the cash that it's creating? What net working capital requirements are going to exist, if any, beyond, of course, the initial incremental amount? And then what are the cash flows, right? What is being produced as a result of this project? And then at the end, we have the disposal. And so we think of that as, okay, what is the winding up of that investment? We did a quick example of that when we did the lease versus buy for the autos, right? The idea is we decided that we were going to keep both of the cars forever. An alternative way to examine those costs would have been, well, what if I were selling both of them at the end? And we would have needed to consider what would we have expected to be the proceeds for the sale of that car. Of course, the lease we didn't have to sell. Okay, so we're going to start with some basic net present value calculations, and I put basic in air quotes because they're not going to feel so basic by the time we're done. So Scythian is considering a new computer system for its warehouse inventory. And so the cost, including installation, is $60,000. And then the operating costs per year are $30,000. It has a 4-year useful life, and it's expected to reduce cost for $62,000 a year. And Scythian's cost of capital, which I'm just providing to you, is 10%. Okay, so in our first example, we'll do what is the net present value without any consideration of taxes. So the first thing we would think of is what is the net cash inflow each year? And the net cash inflow each year is the $62,000 that it's going to reduce my costs minus the $30,000 of additional costs that I incur. So that's a net of $32,000 of cash inflows. If I discount that back at 10%, if I go and use something known as the annuity table, which an annuity is simply a series of periodic payments that are equal. And when we get to the Excel version, I will show you how those calculations differ. But you can go to your present value of annuity table for 4 years at 10%, and you would find that the factor is 3.170. And so the present value of those 4 inflows of $32,000 is $100,440. Now that sounds really good, but we have not considered the cost of placing this piece of capital in the service, which is $60,000. That is at the present time, so there's no need to discount that back, right? That happens at, if you will, time 0. And so we can net that against the present value of the cash flows and realize that we'll have a positive net present value of $41,440. Okay, now we're going to skip out and take a look at this in Excel. Okay, now we're going to work in the Excel template that I built for you guys. And so you can see that I have structured the 4 years worth of cash flows plus the initial investment at time 0. And so now what we need to do is basically create the after-tax cash flows. And this should feel familiar. We did this in the tax part of this course. Basically the same idea. So the initial investment is an outflow of $60,000. And then recall that each year we receive an inflow of $32,000. Okay, so there were no taxes in this particular example. And so the next step is determine what is the present value of these cash flows. And one of the reasons I've placed these numbers at the top is we're going to use them in calculating the present value. So we know that we can use the present value function, right? So here's the present value function, and we're getting used now to knowing that we need to populate these items. So I have a rate. I've provided that up here. So the number of periods I'm putting in is actually available right there. The payment amount is non-existent because these aren't equal payments. We could do it that way, and I'll show you that in a second, but this is just an individual payment. So the payment is nothing, and the future value is $60,000. Now, what do you suppose the future value of $60,000 is? If I discount it back at 10% for no periods at all, it's $60,000. Okay, what I want to do, and we've seen this before, is I want to treat present value as an outflow. So I'm going to make that negative. Okay, now I need to do the same thing for the other periods. But what I want to do is I want to fix this rate. And if you've never done this in Excel before, this is a cool trick. A dollar sign is an anchor. And so now that no matter where I copy this cell, it's going to be anchored to cell D2. But the good news is I can now just copy this formula over as opposed to retype it 4 times. So now I've calculated my net present value as the sum of all those cash flows. And it's $41,436. And that differs just a little bit from the amount we had calculated using the table. And that's largely due to rounding. Okay, now what I want to do is recreate that same calculation, except doing it the same way, because notice that what we have here is a series of equal periodic payments. Okay, and again, we call that an annuity. So a different way of calculating the same thing is I've set up this cash flow that's going to occur for 4 periods at 10%. And I can actually calculate that the same way. So what is the present value? Well, I have my rate. I have the number of periods. And in this case, I'm treating it not as a single flow in the future, but a series of equal periodic payments. So I can classify that as a payment and ignore the future value. There we go. And I get the present value of those inflows. From that, I can subtract the initial flow of 60,000 and look at that. I get the exact same answer. So I prefer this method of calculation if I'm using Excel, because what it does is it allows me to make complex cash flows in different periods, right? So the world is full of periodic equal payments, right? So most debt, any car loans you have, any mortgages you have, those are generally structured as equal payments. If I buy an annuity, it's structured as equal payments. And so it can be super frequent to be able to calculate present value this way. And you can see that it is, it's fewer steps. What happens is if we have non-equal periodic payments, that won't work. Okay, so given that, let's go back to our PowerPoint slides. All right, here's our next iteration. So what is the net present value now if we include 30% tax? Okay, so once we invoke tax, we need to consider something that we didn't in the first scenario, which is tax depreciation. So we're going to try to make this easy, and we're just going to say tax depreciation is straight line over 4 years. And so now we need to consider the tax effects in this particular scenario. So let's go back to Excel. Okay, so here we are in Excel, and we are getting prepared to process the same cash flows we did before. So the initial cash outflow is $60,000. Then I have a series of equal $32,000 payments that occur each year. But I need to consider the tax effects. And so one of the things that's going to occur is I now have depreciation that I need to consider. So depreciation is a non-cash tax deduction. And I'm using a straight line method. So I think one of the ways I want to do that is I want to calculate, well, what is my depreciation factor going to be each year? Okay, so if depreciation is straight line over 4 years, then it seems pretty obvious. It's just the amount of the investment divided by 4, right? So now I have a depreciation deduction that is occurring. So that gives me taxable income each year that generates a tax savings based on the tax rate. And recall, the tax rate is 30%. So what I've done is I've said, okay, 32 minus the $15,000 depreciation deduction would give me taxable income of $17,000. 17,000 times 30% is $5,100. So that actually is the tax cost associated with this new income minus the depreciation. So now the after-tax cash flows are the pre-tax cash flows of $32,000 minus my taxes of $5,100, or $26,900. So now I can use the same present value function to calculate back the present value of each one of these and get the net present value. Okay, let's go back to our PowerPoint slides. And the next question is, let's calculate the internal rate of return. So the book describes what the internal rate of return is. So rather than go through that, we're going to use Excel, and I'm going to show you how to calculate the internal rate of return. So let's go back to the first scenario we had, because the question asked us to do it for the first two. And you can see I've done a little hiding of cells over here, and I want to talk about that in a second too, because that's called a subgroup, and that's a great way to hide cells inside a spreadsheet. So the way you do that is you go to Data, Group. Now let's say I want to ungroup. So I'm going to ungroup the columns. Whoops, I didn't highlight any of the columns I want to ungroup. There we go. So I want to ungroup those columns. It's now it's gone. The way you group them is you highlight the columns and you group them. And now it gives you a little symbol. Boom, you can hide them. Okay, so that's good for presentation purposes. Not a lot more, really. So now I have to calculate the internal rate of return. The great part is it should come as no surprise that Excel will calculate the internal rate of return. So let's start this calculation over. Internal rate of return, and it simply says, well, what are the values I need to calculate on? Well, there they are. There are my payments, and it says my internal rate of return. So the rate of return I'm earning on my investment is 39%. Not too bad. So now that we know how to calculate internal rate of return, it's a simple matter to do it in the second version, right? Again, so if I show you the formula, you can see I am picking up the after-tax cash flows. The internal rate of return is automatically calculated as 28.27. So you can see the taxes chew apart a little bit of my internal rate of return, and we talked about that during the tax module. Okay, let's go back to PowerPoint and do our next iteration. Okay, so now we've got net present value, 30% tax, but our tax depreciation is going to be double declining balance over 4 years. Okay, so that's clearly more complicated, and we're not yet using the tax tables, and we know that we probably really should just be using the tax tables. But we're going to follow along the examples as they're provided in this management textbook, because if I give you a quiz question or an exam question and it asks you to do it this way, I want you to be able to replicate it in this form. So let's go back to Excel and let's go to our third example. And we need to do the same sort of thing. So the real complication here is how do I calculate double declining balance for this particular scenario? So I think one of the things I want to do is create the double declining balance factor for each period. So remember that double declining balance is simply straight line where I double it. So we're not considering half-year conventions. We're not considering any of the actual tax rules as we do these. We would be better suited if we did, but we're going to roll with what the book does. So I like to think of that as, let's take $1 and divide it by 4. And then it's double declining balance, so we multiply that by 2. So my double declining balance factor for the first year is 50%. So I can take depreciation and set up a formula that says take my initial expenditure and multiply it by 50%. And that's going to give me year one's double declining balance depreciation. Okay, so how about year 2? So year 2, remember, in the double declining balance system, we're going to take that initial investment and reduce it. So the declining balance, right? Get rid of last year's depreciation, divide by 4, straight line, multiply by 2. So the following year, so year 2's double declining balance factor is 0.25%. Now we can do the same thing in year 3. That's my initial balance of $1 minus first year's depreciation minus second year's depreciation divided by 4 times 2. 0.125. Okay, and the reality is in the third year I have to get rid of everything, and it just so happens that's also 0.125. So you can see that if I add up these cells, they total to 1. Okay, so that's my 100% double declining balance. All right, so now I've got depreciation calculations for each period. I can calculate taxable income for each period, and you can see the effective double declining balance, as you would expect, is I have a much greater amount of depreciation early on in the life of the asset. So my taxable income is lower in the early years of the life of the asset, which means my taxes are lower in the early years of the life of the asset. And that's advantageous, as we know, because that means I've accelerated deductions. Okay, so the after-tax calculations are simply the pre-tax minus the tax. Then it's simply a matter of calculating the present value like we've done so many times before, right? I use the rate, the number of periods, and the future value. And you can see now that these are no longer equal periodic payments. So using the annuity table would be inappropriate here. It's going to give you the wrong answer because these payments aren't equal. So, but this model does work the way we built it now because we calculated each one separately and the net present value is 26,133. Okay, back to PowerPoint. We've got one more to do. In our fourth scenario, tax depreciation is double declining balance, but now we're going to have the added complication of we're going to have that disposal cash flow. So we're going to sell the system for $3,000 on the last day of year 4. So think of it as we've completely depreciated the asset, even though we know that in the year of disposal, you would only get to take half of that. But so imagine, if you will, it was on the first day of the following year. Either way, the book kind of simplifies these assumptions under the guesstimate on their part that you don't know anything about tax, but that's simply not true. Okay, either way, let's go back to Excel and work this last version. Okay, so one of the ways I want to do this is we only have a moderate change from the last one. So I don't want to recreate this entire template. So I'm going to copy this entire sheet and paste it here. So now what we have is the exact same calculation from the previous version. So we've picked up the double declining balance. I don't need to redo that. So the only issue is I have this $3,000 of proceeds that I'm going to receive at the end. So the complicated way of thinking of this is, what is my amount realized? 3,000. What is my adjusted basis at the time of the sale? Well, it's fully depreciated, so it's 0. There's my realized and recognized gain. So I need to include the $3,000 of proceeds where in my pre-tax cash flows, which automatically rolls into my taxable income. See how taxable income is now increased by $3,000 over the 24/5? That's because that $3,000 gain is automatically being buried in my pre-tax cash flows. So as a result, my taxes go up just a smidge. In this example, we're assuming that the capital gains rate is the same as the ordinary rate, which we know would be true for a corporation anyway. And so I've recalculated the net present value of this as $27,567. Okay, so we've done 4 examples. Hopefully these helped you. All the solutions to these are posted in Blackboard as well, so you can go back and take a look and look at how all the formulas were baked in if that's something you're interested in. And look, what if you got a capital budgeting question on the quiz, or what if you got a capital budgeting question on the exam? I think it's safe to say that the quickest way to resolve these is in Excel. So being somewhat familiar with these Excel models could really help you if you ended up having to do something like this later on. That's the end of video M12A. Now that we have some of the basics under our belt, the next video starts the discounted cash flow model. How exciting! Thanks for watching.